Welcome back to the Dividend Diplomats YouTube channel. You got your boys, Lanny Bert, the Dividend Diplomats. Yesterday we talked about Johnson Johnson Kenvue. Today we're going to talk about my watch list. And yes, Lanny, we saw you kissing your muscles there. Everyone caught that. Don't think we missed it here. So get ready, buckle up. We got 3 dividend stocks to watch and buy in my portfolio.
This goes out to the millions and millions of dividend investors out there, guys. It is the Dividend Diplomats here, guys, on the channel. Bert's got 3 stocks. He's deploying capital still. He's putting money to work because he doesn't give a flying what's happening right now in the stock market. Yes, that was a personal, individualized blink out right there. 3 stocks here, guys. All 3 stocks are down in the last 52 weeks. 2 stocks are down the year to date. 1 stock is actually up close to 8%. Bert, you own all 3 stocks.
Yep.
And 1 stock is yielding over 5% here. So you're getting a little bit of yield, but all have demonstrated years of dividend growth. And why is dividend growth, though, important? Let's touch on that for all the viewers.
Yeah, because look, we're all fighting inflation here. We're all protecting our dollar. And the reason why dividend growth is so important is you have an income stream, but you need that income stream to continue growing to keep up with purchasing power. So you don't lose purchasing power. Keep up with all those increased costs. Sure, inflation was only 3.1% in July compared to the last year, but it's been on fire so far in 2023. You don't want your hardworking income stream to lose the ability to purchase goods because of increased costs, especially if you are working towards financial freedom and you are living off this dividend income stream, or you want to live off of it soon. It is critical that your income stream continues to grow.
Absolutely. And that's why if you're looking to buy something in the sky high stock market, Bert's got 3 tickers here that could be right up your alley to add a growing passive income stream. Bert, let's hit him with the first one that you've been squashing and building.
Qualcomm, ticker symbol QCOM. You're going to see a theme here in my watch list because buying stocks in the last couple months have been hard in this market. I haven't been deploying a ton of capital to individual stocks. I've been nibbling, and that caters towards being able to add to positions already in my portfolio with a share here, a share there. And that's why Qualcomm is a perfect fit after earnings. Been building them, and we now own a pretty healthy position. I believe it's almost $5,000 in market value here. And our cost basis is in the 110s per share now. We love the chip maker. Why are they down? They got crushed after their earnings release. They missed earnings. They have lowered their guidance. Even though revenue was over $8 billion, it was down 22% year to date. It missed expectations. Net income was down 52% year over a year.
52% net income is down.
Yeah, and smartphones are the story for Qualcomm, and softening demand is spooking investors a little bit. Still with that, though, had a lot of revenue, had a lot of net income. It just didn't meet the mark, and the forward guidance came down.
Yeah, I mean, guys, does this give you a little flashback of the Intel scenario where everything was just dropping like an anvil, like you saw in the Looney Tunes? And we're not being too loony here because this is serious.
Very serious. So let's run through our screener, which focuses on the 3 metrics: PE ratio, payout ratio, history of increasing dividends, and that dividend yield. Their current price, we're filming this on Thursday, August 10th. So it's not the Friday prices, it's the Thursday. So keep that in mind. Qualcomm was $115.61 per share. Forward earnings is $8.30. That's a PE ratio of 13.93.
Pretty cheap, inexpensive. I'm liking it. I wouldn't even say the word cheap. Probably, yeah, you get good value here, guys. And they pay a 90 cent per share per quarter and $3.60 per share per year. That's a perfect payout ratio right now at 43%. And guys, they grow their dividend. Unlike Intel, who cuts theirs, unlike all these other terrible news that we've received this year, Qualcomm in a tough year, tough industry, still growing that dividend. 19 plus years at 5.5%, guys. This is a growth stock that is paying a nice growing dividend.
Yeah, they're conservative with their dividend increases, and that's perfect in times where you're facing tougher revenue, tougher earnings. It's still critical that you don't overextend yourself on the dividend growth front. You don't overextend yourself on the payout ratio front. You have money to reinvest in the business and continue to reward shareholders. So they're very close to being that aristocrat too, which is fantastic at 19 plus years of increases.
Wow. And guys, they yield over 3% now. Since they're down 22% since this time last year, they're up slightly this year, almost 8%. But guys, a yield of over 3.11%, close to your favorite ETF, SCHD, slightly resembling your VYM, 2 times the S&P 500, definitely yielding higher than your boys at Intel right now, INTC. So
Yeah.
great stock here right now.
Yeah, so let's move on to number two. We're actually going to head to the REIT sector for the rest of this video. So for in our screeners, take out earnings per share, insert
Get
FFO,
that out of
industry
here.
standard. So everything's going to be the same, just price per FFO and so on. So first one, Realty Income. I've been talking a lot about Realty Income. I love this stock right now. And
Love the stock.
I do. I love the monthly dividend payer. They are one of the goats in the real estate investment trust sector. They have their single tenants. They have sky high occupancy rates. They're diversified well above the top 20. They're not overexposed to any one tenant and one tenant issues, which is critical right now in retail, as some retail companies continue to struggle to find their foot.
Guys, their stock price has dropped, but they can continue to raise dividends on a frequent basis. And that's why you've got to love Realty Income.
Yeah.
Guys, we've all seen the retailers that they house and the businesses that they have. Again, fairly diversified. Net FFO ratio is looking pretty solid at $4.13 right now on a go forward basis. So with them trading at $58.79, a 14 price to FFO is actually pretty good from what we've been able to see recently.
Yeah, that's right. And their payout ratio is very low. It's at 74%, which is lower in the REIT sector, which is perfect. So if there is a slight earnings compression as a result from this slight FFO compression, Realty Income is able to absorb it and continue those critical quarterly dividend increases that everybody loves for this stock.
That's right, guys. And hey, we've already said it. They continue to keep growing that dividend. 26 years plus. They're a dividend aristocrat stock, so they have to have been doing it for over 25 years. They do it at about 3.73%, which we'll get into the yield next, pairs pretty nicely. So with them being down so much, Bert, what has that yield swelled and what have they hurdled over?
5.22%. So they've made a nice increase here. And that's always the mark that gets my interest in Realty Income. A 5% plus yield is when I'm really honing in on Realty Income to continue buying and growing my position.
Bert, are you buying this right now in your taxable account or in your Roth account?
My position's in my Roth, so I'm getting some early Roth contributions here in 2023 for what I'm used to. So I'm buying 2, 3, 4 share chunks at a time. It's been a nice, I think I did that the day we recorded this video here that Thursday. I was pissed off. I just wanted to buy something and I grabbed 2 shares of Realty Income. So it's nice, no tax consequences in the Roth. So that was dividend stock number 2. I mentioned number 3 is a REIT. We're going to go to my wife's portfolio, American Tower, ticker symbol AMT. It's a stock I've been touting this year. It is not the highest yielding of REITs. So I'm just going to get that out of the way right here. Their yield is only 3.36%, which is low for a REIT, but why do I continue to like them? They dominate with one other REIT in a sector that's going to continue to be critical. They own cell towers. They acquire data. Think about where this data centers, I should say. If you think about where the industry is heading, people aren't using less smartphones. People aren't getting dumber devices that aren't plugged into the network. It's only going to increase in the investment, and it's going to be critical. And it's owning the stock that owns the towers for all the cell providers is where I want to position myself right now.
Yeah. Yeah, you don't want to own more of AT&T or Verizon, Bert saying. He goes, you own the towers that they have to lease them from.
Exactly right. Then you can get say from T-Mobile. There's all different ways to do it. So I said at the beginning of the year I want to own at least 10 shares by the end of December. We're at 9 right now. So this is another candidate to just keep nibbling, keep adding 1 or 2 shares
No,
at a
you've
time.
got this, guys.
Yeah.
You've got this. This stock is down 32% too since last year.
Yeah, it's down. And I mean, their earnings were great. It was quietly great. They boosted their AFFO guidance. Revenue was up 4%. Property revenues were up over 4% as well, like 4.4% versus 3.7 on the top line, unrounded. So there's a lot of quiet, good news for AMT, despite the headwinds that are caused by the noise and disruptions that are going on from AT&T and Verizon.
It's beautiful. Guys, let's get into the metrics here. They're trading at 186.94. That FFO guidance right now we're looking at is $9.76. So price to AFFO or FFO, you're going to notice a little bit higher than Realty Incomes, which was 14. They're actually over 19 times FFO right now.
Not the cheapest. I'm not gonna lie. It's not the cheapest. It never was when I started buying it, but it's a quality REIT. So that's why I want to get the position to where I want it to go and get out of there. So let's look at that payout ratio. $6.28 the dividend. The payout ratio is 64.34%. It's an even lower payout ratio, which is great. And that also probably explains why the yield isn't so high for AMT.
Yeah, I mean, but again, growing dividends at double-digit marks is not an easy thing to do. And guys, 5-year average is 16%, 16.4% growing dividends. So you better believe that your AT&T and Verizon stock isn't growing a dividend by double digits. Heck, you're praying for mid-single digits if you can get it. But they've been doing this for 10 years.
Yeah.
And but that yield now is actually looking pretty nice because I remember when they were in the twos quite a bit. But now I can see why it's back on your radar, given where the yield is at and where is that yield be.
3.36%. So it's climbing. It's climbing. Slowly but surely it is climbing. And that's
Yeah,
what's yeah. So I'm gonna get that dividend. I'm gonna enjoy that. My 9 point something and change shares will get that nice 3% yield. But I'm excited to build it and continue growing that position, nibbling one share at a time.
guys, what do you think about these three stocks? If you had $500, what stock are you buying from this list? If you had to, you had to pick one. Let us know in the comments below what you're doing. What other stocks outside of that little test? What other stocks to buy are on your radar right now?
If you haven't already, subscribe to the channel, give the video a thumbs up. And remember, if you're not with us, you're against us. So get out of here, Jack.
Yeah, guys, that was NWO style, DDWO, Dividend Diplomats World Order, brother. That was Bert, the Hurt, and Lanny from the Dividend Diplomats over and out.